I'm Robert Poe, the managing partner of KerNors, LLC, and I'm here today to talk about the 5 engines of real estate on the board behind me. These principles have served our company over 60 years and kept us going through hard times and good times. I believe that in this difficult market, there is more call than ever for going back to the basics and the fundamentals. Traditionally, there have been 4 engines of real estate: cash flow, equity buildup, tax advantage, and appreciation. Today, we're adding a 5th one called leverage. The first one I'd like to talk about is cash flow. This is the central key theme to most real estate investments and is one that we highly emphasize in our company. Cash flow can make or break commercial real estate investment. Essentially, it's the aggregate of all your rents, other fees, and other rental income from your properties put together into one piece property, and then it drops down to the bottom line to pay out to investors, to reinvest for other purposes in your property. The second one is a term called equity buildup. Essentially, this comes from 2 sources. First source would be pay down of your loan over time. Every month you make a payment on your loan, you pay down the debt, but you also build up the equity in your property. This is a great forced savings plan, if nothing else. And what it does, it allows you at the end of several years to look at your property and say, I paid down the loan balance, but I've also gained quite a bit of actual physical equity that I own in the property. It's a fantastic wealth building tool, and over time it grows up. The third one is tax advantages. Real estate has many, many tax advantages that are unique to it as an asset class. Unlike gold, unlike stocks, unlike bonds, you can deduct interest on loans, you can deduct property taxes, you can deduct operating expenses. You can also do a tax advantage exchange where you're allowed to defer your gains on investment and roll them into the next property without having to write a check to the tax authorities. Over time, this can build up to a significant amount of equity. At some point, you do have to pay the taxes. However, in the meantime, you can put aside other money to pay those taxes at which point you decide to pay them. The fourth one is called appreciation. Now, over the last several years, this hasn't been exactly the best play in real estate. There's been a number of problems in the market. We've had a number of distressed markets. But historically, over time, real estate has proven itself to have a very nice appreciation factor, even beating inflation or meeting inflation in many cases, unlike a lot of other investments that get eroded by inflation. The 5th one we've added today, we're breaking the mold here a bit, is called leverage or loans. Now, over the last several years, again, that's gotten to be a very bad thing. In some cases, people have abused this. But if you stay within conservative lending limits, you use leverage property, it can be a great tool because it can allow you to control a large asset with a small amount of money down. What the key is to have enough money down to make the investment work properly and not have a negative cash flow or have a break-even cash flow. What has happened with people in the past is they borrowed way too much money on properties and put on second and thirds and then crushed by the debt burden. But applied properly, leverage can be a very valuable wealth building tool. Thank you. I know you'd like more information on this. Please visit my website at www.kernors.com. Again, I'm Robert Poe, and thank you for watching.